The American jobs market seems to have stalled while inflation is persistently high. That makes for a difficult meeting this week of the Federal Reserve's Open Market Committee as it makes its decisions about interest rates. Will Donald Trump's appointees to the Fed dissent from what is expected to be a 25 basis point cut as they lobby for an even bigger interest rate cut, as President Trump has urged them to do?
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
The health of the economy is our focus today on Potomac Watch. I'm Paul Gigot here with Joe Sternberg and Mary Anastasia O'Grady. So it will be a big week for the Fed. Let's talk at first about the economic backdrop here. Two bad jobs reports for July and August here of late. Very little job growth overall. And a big bump last week in new jobless claims, the biggest in quite a bit of time, up to 263,000. The jobless rate remains low as of the last report at 4.3%, but there are signs of trouble. Not a lot of people are getting laid off, but not a lot of people are getting hired. Meanwhile, consumer prices popped up in August by 0.4% or 2.9% for the last 12 months. Of course, the Fed's target for inflation is 2%. So what's the state of the economy right now, Mary? What do you think? I mean, are we in a stall mode?
Well, Paul, I think you captured it very well there. I mean, we have a slowing economy and we have rising or weakening jobs market. And we still have inflation that's well above the target of 2%. So something's got to give. And, the Fed Powell thinks we're in a good position. The Fed's in a good position. It can afford to wait and see. I expect that they'll probably cut, say, 25 basis points the next time. And then they have a couple of months left in the year to see if they should cut more. One thing I'm paying attention to is the quits rate. When the job market is very hot, you see a very high quits rate, and quits, particularly in construction, has slowed to a crawl. So that tells you that jobs are not being created. The unemployment rate remains, as you mentioned, I think at 4.3%, but that is a rate that tells you the number of people looking versus the number of people employed. So if you have a lot of deportations, you might have fewer people looking, and so you don't have such a high unemployment rate, but you still might have a very weak jobs market.
It's really an interesting economy, given these different parameters, because Joe, we pay attention to the financial markets here in addition to the labor market. And as I look at the financial markets, they don't look particularly tight or restrictive. I mean, you have the stock market at new, maybe record price earnings ratios. AI, artificial intelligence stocks are in the stratosphere. Seems to be plenty of money around. Junk bond spreads, that is junk bonds rate above treasuries, are really low, suggesting a very much of a risk-on environment. Subprime debt growing. Remember that word subprime from the days in the housing market before the panic of 2008. The exception is housing. Obviously, given the high mortgage rates, housing has been down and maybe even in some markets close to a recessionary level for some time. But it's I mean, you can almost see a kind of bifurcated economy. Wall Street looks to be doing great. Main Street, not so much.
Yeah, and I think that there are a couple of conclusions that you can draw from all of this. And one of them is, I think Mary is absolutely right about all of the soft spots in the economy. And I think that the important thing that is going on there is that, there's a tendency in the academic world and the policymaking world and the media world to talk about the economy in terms of these specific data points. But the politically salient thing is always, how do people feel? Do households and voters have a sense of well-being about the economy and the opportunities that they have? Mary was describing a situation where you can understand how there's going to be rising unease about that. But at the same time, what's happening in financial markets is a clue to what the problem is and what the problem isn't. Because, the classical way of thinking about the economy and economic policy, and especially monetary policy, which is in focus this week, is that ultimately economic growth and opportunities and all of the benefits that come from that trace back to the availability of capital in the economy. And that certainly is the way that the Federal Reserve thinks about what they're doing and their use of changes in interest rates to try to influence the economic outcomes. I don't see an economy where capital specifically is the issue. I think that companies that want to invest are having no trouble finding the money to do it. And in fact, these very rich stock market valuations and this risk-on appetite to low-grade corporate debt suggests that actually there's a lot of money out there chasing too few productive investment opportunities. The problem with the economy is that people perceive that there are too few productive investment opportunities. And I think that, you can go down the list of reasons for that, whether it's unease or uncertainty about tariff policies and the effect that that has on supply chains, whether it's the immigration crackdown that's going on and the implications of that for the availability of labor in the economy. But we're in this situation where we're talking this week about monetary policy and sort of these financial linkages and pipes in the economy, but that isn't really the thing that seems to be causing the weakness or uncertainty right now.
Two big policy changes, Mary, that Donald Trump has made since taking office. Leave aside the big, beautiful bill that passed Congress. The impact of that's, I think, in the offing. And as well as deregulation, that's kind of slowly taking shape. But the two big policies that have been really implemented in a big way: tariffs, the president's tariffs to the tune of about $300 billion a year in new taxes, border taxes taken out of the economy. That's the estimate. And I think in August, it was something like $24 billion taken out given to the Treasury in new tariff revenue. And then you have the deportation policy, mass deportation policy. Don Luskin, our friend, Wall Street analyst consultant, says that there have been about 1 million people, he thinks, illegal migrants that have left the labor market just since January. Now, both of those things have a big effect on growth and not favorable.
Yeah, a big effect on growth and a big effect on prices. I think one of the problems that the Fed confronts as, this meeting looms and going into the fall is, are the price increases, particularly in goods, coming from tariffs? And are they a one-time move up? Or are they, and if they're a one-time move up, they're transitory, Paul. That's a word that Jay Powell probably didn't want to hear again. Or are they something that is going to cause ongoing inflation? So they need to be sure not to accommodate the move up in prices, the spending that goes along with the move up in prices. And something similar in the labor market, because what ends up happening if you don't have as much labor availability, then the cost of labor goes up. It's a supply and demand factor. So will these policies that Donald Trump put in place not only cause a slowdown in the economy, but put upward pressure on prices? That's the problem that the Fed is grappling with right now.
Well, on that point, Mary, does the Fed has to make a decision, right? Do we want to somehow look through those price increases and thinking, okay, they're one time, or will it somehow accommodate those price increases as it seeks to offset them and set up a new spiral of inflation?
Well, Chris Waller, who's on the Board of Governors and wants bigger cuts, thinks that, nominal spending has slowed, and, we've actually got this. And so the neutral rate is actually lower than where the Fed is.
The neutral interest rate.
Exactly. But I think Jay Powell, as I mentioned before, he thinks, okay, we're okay here. If we do a 25 basis point cut this month, and then we can wait and see how things look. In other words, he doesn't think that we have to rush into these larger cuts, and certainly nothing close to what Donald Trump is asking for, which is like 150. I think there are risks on both sides for sure. And Powell just thinks he can take a little bit more time. And the doves on the committee think that if he takes more time, he's going to end up being behind the curve, and he's going to tip the economy into a recession. And that's what they're grappling with.
I think you're too modest in the Donald Trump expectation. I saw a tweet where he said we need 300 basis points.
I'm not keeping up.
Which would here in the last 24 hours, he said we need a big cut. Housing will boom if that happens.
And that's sad because, of course, you can cut the very short end, but what the longer end, which is where mortgage rates are set, is looking not only at what the Fed's doing, but it's also looking at inflation. And if you cut too aggressively and you spark a kind of feeling that inflation's on the way and the Fed's being too accommodative, you're actually going to spike those longer term interest rates. I have to laugh when people say they're very high, because they're not high, obviously.
Historically, they're not high.
But they're high compared to a few years ago.
Yeah, they're high compared to the post-crisis of 2008, 2009 experience, but not historically at all. So, Joe, I wonder where you come out here on all of these factors, which I think make for a very difficult choice by the Fed. I don't think the markets seem to think it's going to be 25 basis points this time, another 25 in October, another 25 in December, and rate cuts as far as the eye can see. Okay, but I think there's a case for not cutting. Given the froth in financial markets, given the recent inflation numbers. What do you think?
So I am not always sympathetic to Fed Reserve Chairman Jerome Powell, but I am in this case. So Jay, if you're listening, today's your day. It's hard to think of an economic environment that has been this complicated. We've talked about a lot of the negatives that he's dealing with, the inflation, but also the frothy financial markets, uncertainty about what's happening on Main Street with employment or business investment. I mean, we should also point out that there are some positive factors out there. I think the ongoing AI revolution is a big one that has big potential upside for the economy and productivity, but also interest rates. So I think that they're in this situation where they're trying to balance all of these things. And then also, you almost get the impression that there's a prudential political thought process going on here, because they are facing this unusual amount of pressure very publicly from a president who is demanding a very specific and very aggressive kind of monetary policy. And I think that, we don't know for sure that this is the thought process going on at the Fed, but it wouldn't be crazy if he is thinking, well, from the perspective of defending the Fed's institutional independence, what are steps that we can take now that are kind of plausible, that, also potentially lead to easing up some of this political pressure that we are facing without completely bowing to it. And I think that this is a really unenviable task that they have, but I think that it would be a lot easier if inflation were currently more under control than it is. I think that this is compounded by the fact that they never fully got inflation back to the target before this current situation started. And it's complicated by the fact that it's not obvious that the problems that the economy has are monetary policy problems with a monetary solution.
Joe, I still didn't hear whether you think the Fed should cut rates or not.
I would probably stand pat if I were them, because I would be concerned about financial stability risks, from this very risk-on environment, and also from the disconnect between financial markets' willingness to embrace risk right now. I mean, the enthusiasm for junk bonds that you were talking about, and the return of subprime lending, and all of these other factors. The disconnect between that on the one side and all of the uncertainty that's happening on Main Street at the moment. Because remember, for all of this high risk financial activity to pay off and not end in some kind of crisis, you have to have very robust economic growth out on Main Street at the end of the day. And so, you worry if it looks like the financial markets are getting out ahead of a plausible guess of the Main Street economy to make good on all of that debt.
To elaborate on the Fed's decision, Mary, we have the political factor that Joe cited, and that is that Donald Trump is putting enormous pressure on the Fed and Fed Chairman Powell. And that pressure is now going to have an inside man. In the Senate is expected to confirm here Monday night on basically on speed dial, Stephen Myron, the chairman of the White House Council of Economic Advisors, to fill an open seat on the Board of Governors, vacated by Adriana Kugler, who left in August, and her term expires January 31st. But Myron is going to be confirmed to fill that spot, and just in time for this FOMC meeting this week. Now, he will join Michelle Bowman and Christopher Waller, two governors who Donald Trump nominated from the first term and have both called in recent weeks for rate cuts, albeit having previously said they'd stand pat. So you're going to have at least, I think, three very strong voices for rate cuts, and maybe not just for 25 basis points, maybe for 50 or more. And it's going to be fascinating to watch to see when the FOMC reports what's the policy change, number one, and then who's dissenting from what.
Yeah, I think, we're used to kind of more consensus on the board, and it looks like that's breaking apart. So there will be three votes that are more dovish than what Jay Powell and his allies on the board vote for. And those three votes will lose if they try to go much further.
You think so? If they go above 50, you think they'll lose?
Yeah, they'll lose. I mean, the rest of the governors will not vote for that, and nor will the Fed presidents on the FOMC. So I think what we'll get in September is 25, but maybe with some soft comments in favor of something going further as the last few months of the year unfold. Jay Powell, I think, express a willingness to be open to that possibility. I mean, the problem that they're facing, which I've sort of tried to frame here, but I'll just say one more time, is that a slowing economy doesn't mean that you've whipped inflation. We do have this word from the 70s called stagflation, where you have inflation that's high, but you also have slowing growth. And that's the problem the Fed is confronting right now. And if they I think most of the Fed, those who will vote, are worried about that because, if the economy slows, it's not necessarily, as Joe pointed out, a monetary issue. It could be just bad policy, like higher taxes, which Trump has imposed, and less labor supply. So I think that the majority will still come down on the side of Jay Powell. I think they'll be moderate in their cuts, but there will be this growing clamor, both on the board, which is in the three votes that go against him, and outside of that, from people like Donald Trump and his supporters.
Well, notwithstanding what the president often says, where everything is fantastic, the economy is booming, and so on, I think he can see the economic data, Mary. I think he can see that the job market has slowed. He says it was rigged by the Bureau of Labor Statistics. I think he knows that the job market is slowing. I think he has, on occasion, acknowledged that tariffs might have a short-term, as he calls it, negative impact on growth. I think he's counting on the Fed and a big rate cut to try to boost the economy. He thinks it will. He's cited the housing market in particular, but as you point out, if the impact of that is to spur inflation or God forbid, a big jump in inflation. But even if there's not a decline in inflation at 3%, that's a big decline in purchasing power for people. And coming off of the 2024 election, where I would argue that Trump's victory owed a lot to the inflation and the lack of real wage gains under Joe Biden. And Donald Trump will be punished, and the Republicans will be punished if that happens on their watch again.
Well, I mean, the policy errors that Trump has made in managing the economy, not in monetary, because that's not his job, but they're pretty obvious. I mean, the economy is going to slow maybe below 2% this year. And he thinks that he can blame that on the Fed, saying you kept the neutral rate too high and you pushed us into recession. And of course, Jay Powell is not running for office. So he's trying to thread the needle here to contain inflation without doing anything too extreme. And for sure, Donald Trump is going to blame Jay Powell if we go into, for the slowing economy. But I think, it's our job to point out that stagflation is not necessarily the fault of the Fed at this point.
Well, and blame the Fed or not, Joe, I'm going to give you the last word here, but blame the Fed or not. What will matter is how voters feel. Do they feel better? Do they feel more optimistic? Do they feel like they're finally getting ahead in terms of their wages keeping up and exceeding inflation so that they don't have sticker shock at the grocery store or at the, gas prices are down, but at grocery prices decidedly are not. So that's what matters. And that's why I suggest that the president should be wary of getting what he asked for with a big rate cut.
Paul, the key point about what you have just said is that the voters tell you. You don't tell the voters if you're a politician. I mean, remember, President Biden and a lot of Democratic politicians before the last election tried to do this act where they basically said to the electorate, you morons, this data is so great. Don't you understand how good you have it? And the voters looked at them, scratched their heads and said, what are you guys talking about?
Yeah, they said, we don't understand. You're right.
Yeah. So I think that this is really the political situation that Trump and the Republicans now have to be very wary of. And I think that Trump has really started falling down that rabbit hole himself with all of this toing and froing about the Bureau of Labor Statistics and other economic data and that sort of thing. I mean, you have got to listen to what the voters are telling you about what they are experiencing. And I think that successful politicians orient their policymaking around the signals that they are getting from the electorate about what's happening out in the economy that people experience around the kitchen table. And the unsuccessful politicians focus a lot on the economic data and then try to flim-flam the voters into thinking things are better than the voters think they are.
All right, that's the last word for today. Thank you, Mario Grady. Thank you, Joe Sternberg. Thank you all for listening. We're here every day on Potomac Watch.